the IEA report hasn't changed very much month on month. The demand numbers are still the same. They continue to overestimate non-OPEC supply growth prospects for next year. They've got about 2.2, 2.3 million barrels per day of growth. And that's why they're saying that, OPEC will need to cut production next year because they see the call on OPEC crude, which is essentially how much crude OPEC needs to supply to balance the market, falling by 1 million barrels per day next year. Now, we have similar numbers on our overall liquids balance, but the IEA, for instance, doesn't distinguish between the crude oil market and the liquids market, which includes NGLs. And I think that's where they're missing the point, that the oversupply is actually going to be in NGLs. And OPEC can't influence that. The crude numbers are actually incredibly tight, and we see stock draws continuing into next year. So there is this big problem that the IEA is not addressing.
So let's talk. Let's dig a little bit more into that problem. There is a gap in information, a gap in expectations here. How exactly does that then reconcile itself in the coming months? I mean, we're entering perhaps a seasonally more slow time for consumption in the United States for certain parts of the energy market, other parts more robust. Globally speaking, the picture is different. So what does that mean for then crude oil prices or other parts of the petrochemical sphere?
I think this is the most important question, and I think the market has struggled with this right throughout this year. If you look at the price of oil, it's been fairly weak. We've had so many geopolitical outages, and we've kind of been around $60 Brent for most of the year. Yet, if you look at the physical market, the backwardation of crude, that's been some of the strongest we've seen across all contracts for years. I mean, some people will tell you this is the strongest physical market we've seen ever. There are crude oil physical crudes trading at record premiums, and refining margins have really come under pressure, showing you how tight the market is. But the reason that we've got this dichotomy is precisely because when you do a liquids balance like the IEA does, it's showing these surpluses, and people trading on that basis think, oh, the market's oversupplied. Yet, because of the growth in U.S. shale, what we are seeing is a growth in NGLs, and that's why petrochemicals is where this should play out rather than in the crude oil sector. It's new for the market. It's going to take some time, but we do think next year, as the market realizes that crude is tight but not liquids, I think crude oil prices should go higher.
When you say higher, how high does it go? I mean, are we heading back to 100 for Brent, or are we more targeting maybe more modest moves to the upside, in your opinion?
I would say for now, modest moves to the upside. We should be in the 70s even right now based on fundamentals. For that, you absolutely need more clarity on the U.S.-China trade war. And, that's a whole kind of new set of discussions about where we stand right now. Because, look, demand growth has been weak. It's not collapsing by any stretch of imagination. We're still growing at about 1 million barrels per day, but definitely weaker. And I think the main thing is people need certainty for CapEx spending to come back. And I think that's why it's going to be a modest recovery, let's say into the 70s. But pure fundamentals, there is no reason why crude can't trade into the 80s if the U.S.-China trade talks were to actually give us some meaningful result.